Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today I'm going to have a quick video on Kraft Heinz stock. This one came in by request down in the comments section. If you have a stock you would like me to analyze, just ask down in the comment section, and if it's in the S&P 500, I post those on YouTube for free. And if it's not, I will post that analysis on Patreon, which is $5 a month. And if you join there, you can get a big discount on my full Cyclical Investors Club service over on Seeking Alpha. Those links are in the description. As always, this is not investment advice. It's just how I analyze stocks. And Kraft Heinz should be pretty quick. I do have a couple of kind of interesting, maybe they're not interesting, but they are funny stories. First of all, I do have experience with these. I don't think I've ever written on them, but when my daughter was born in 2009, I opened up a custodial account for her, and I think Heinz was the first stock that I bought for her back in maybe around 2010 or something like that. Maybe it was even 2009, but I bought it really cheap, and Warren Buffett eventually bought it a year or two later, and I got it like a double on that for her. And it was several years later. She was, I don't know, still single digit aged. It was somewhere maybe in 2017 or something, 2018 maybe. And I was trying to teach her kind of the fundamentals of investing at a young age. And I think basically what I did was I was trying to use dividends to sort of teach her. I think they're kind of a good way if you're just learning to invest, because you kind of have the yield there that you can look at, and it's kind of like a bond yield sort of. And I think what I did was I went through and I looked to find a high dividend yield where the earnings supported the dividend, and so that it wasn't just like a super high yield thing. And then we ran the numbers and calculated like how much it would be worth and everything. So Kraft was one of the ones that we bought as I was trying to teach her about investing. And it was after the merger and everything that we see here. I don't remember exactly when it was, but it was somewhere around in here, I think. Maybe earlier than 2018. It might have been more like 2017. And it turned out like horrible. Like I think she lost like 40% or 30% or something. Interestingly, she picked one stock that she wanted to buy at the time, and it was GameStop, and which wasn't like the best stock to buy either. And I think eventually during the meme craze, she would have been up like 2,000%. But I sold these before we got to that point. So the complete opposite lessons would have been learned. I think she forgot about it, and then I just topped up her account from the money that we lost on this one. But so I don't have any hard feelings against Kraft, but and we know that they've been in business a long time. The same goes with Heinz. They're sort of staple businesses, basically. But what I would say is and we don't have a lot of the history because of the mergers and stuff, but we don't really need it too much. We can see these past few years, earnings growth has basically been flat or maybe just barely kept up with inflation. Looking forward, analysts are expecting kind of mid-single digit earnings growth. So I would just say that probably the way to think about this is they'll probably be able to grow earnings at the same rate as inflation, which for me categorizes it as I call them just no growth businesses. There's not really any real growth that's going to come, probably. Now you could either get lucky and get some, but you could also get unlucky and and decline, which is a real possibility. I'm not sure what the PE was back here. Yeah, it was really expensive there. I doubt I paid that much for it. But so now you're at least at like a PE that you would kind of think might be okay for a no growth business. Really, for me, like a no growth business, PE is closer to 8 instead of 12. So you can say that's 35%, maybe less than where it's at now. And then if you get a margin of safety on top of that, you probably need a bigger discount. But the really quick way that I would look at this is, I should say I'm not a dividend investor, but this is the case where I think dividend are actually important. because if you take the dividends out of a no growth business, at least you have kind of an insurance policy that if growth tips negative, that can really send the stock price a lot lower. And you'll at least be able to recoup your investment over time if the dividend, if one, they're paying enough of their earnings out in dividends, and two, the earnings or the dividend yield is high enough, you can at least make your money back. And then who knows, maybe you get lucky and something good happens, and then maybe you can do really well on it. So you kind of have the option on both ways, but you get a little bit more insurance. So for me, that dividend level, and sometimes people laugh at me when I say this, is 8%. Like 7 to 8%. I mean, I wouldn't argue too much if we can get 7% and then with a little inflation protection, right? Which is what this earnings growth would be. And right now the dividend yield is only 4.5. So I'm not sure what their payout ratio is. Let's take a look real quick. So no dividend growth lately. Payout ratio, we'll call it at 60% or so. So they have a little bit room to potentially raise that dividend over time. So yeah, I mean, for me, this isn't like, it doesn't have enough earnings growth to interest me. But if you wanted it as kind of like a bond proxy with some inflation protection, and you thought their business was going to do okay, if they can keep growing the dividend, they haven't really grown the dividend at all, right? Yeah, they aren't even growing it. So they're just holding it steady. So for me, I would say this dividend, you can imagine getting that yield plus maybe inflation. Maybe. They haven't been raising it, so you don't know that you'll get that. But you might get that if they earn a little bit more money. So for me, I'd probably want this to be close to 8%, honestly. And that's probably going to be, well, call it a 40 to 45% price decline, all else equal, before I would get interested as a bond proxy. As a stock, I mean, and they have debt too, so it's just not very appealing to me as a stock generally, because I want more growth. But even if you didn't, I think you want it at least 40% cheaper. So I'm not sure where it trades. 35. Yeah, whatever 40% on 35 is would be kind of, I'll check here. About $20 to $21 per share would be if you were looking for a bond proxy that has a little inflation protection, maybe a chance to go higher. That's probably what I'd look at here. All right, that's it. This was a simple one, and hopefully you found it useful. Hopefully you found the rule of thumb useful, and click the subscribe button if you liked it, and I'll see everybody later. And if you have a request, drop it in the comments, and I'll make a video.